Hi, my name's Andrew Hallam. I'm the author of Millionaire Teacher and Millionaire Expat. Welcome to my investment series for beginners. This is part 6. What percentage should you have in stocks and bonds? No one size fits all. This is a really personal question based on so many different determinants: your personality, your age, what other assets you're going to be having, or cash flow you're going to be having as a retiree. Here are how allocations have performed from 2026 to 2018 according to Vanguard. Many people base their decisions on looking at the long term. So they'll say, well, look, a conservative portfolio of 30% stocks and 70% bonds returned a 7.1% return. A balanced portfolio returned an 8.6% return. So that's slightly riskier, 60% stocks and 40% bonds. And then an aggressive portfolio of, say, 100% stocks ended up returning a 10.1% return. When we compare them, many people decide based on what they see on that right column in terms of returns, and then what they see when they look at the worst possible outcomes. So worst possible year for the conservative portfolio was negative 14.2%. For the balanced was negative 26.6%. For the aggressive, negative 43.1%. So people then ask themselves, well, can I handle a negative 43.1% return in a given year? If I can, then you know what? I want some of those higher, I want that higher performing allocation. So I'm going to go with perhaps 100% stocks or something like 80% stocks and 20% bonds. In both cases, those are really aggressive allocations, and they don't always tell the big picture. If you look at from 1986 to 2020, however, you can see that during this time period, 100% allocation to stocks represented by the blue line would have definitely beaten out a portfolio that was more balanced, 60-40, or a conservative 30-70. You can see how $10,000 would have grown. In 100% global stocks, that $10,000 would have grown to $165,662. It would have grown to $150,000 if it were 60% global stocks and 40% bonds. And it would have grown to just $117,518 if it were 30% global stocks and 70% bonds. But hang on, conservative portfolios sometimes beat more aggressive portfolios. And this is where it's mentally really, really tough, because somebody will occasionally take higher risks with the expectations of higher rewards. And when those rewards don't come, it can really rattle them. So I showed you at the very beginning how there are more single year declines, and the single year declines can be bigger if you have higher stock allocations. But sometimes the investor has to wait a really long time to actually see their higher risk actually validated with higher returns. We have this period from January 2000 until June 2010. So this is a 10.5-year period. You can see global stocks essentially went nowhere. But if you'd invested 60% global stocks and 40% bonds, which is represented by the red line, you actually would have made a decent profit. In this case, mentally, it might have been a lot easier for many investors to have that bond allocation. In the year 2000, bonds were not popular at all. No one wanted them. Much like today, people looked at the past and said, hey, look, the previous 17 years from 1982 to the year 2000, stocks beat bonds by 12% per year. Nobody wanted bonds, but you can't see the future. You can't know how stocks or bonds are going to perform over any given time period based on what's currently happening, their current rates of interest or their recent past performance. Let's look at a longer time period when you would have needed even more patience. January 2000 to April 30th, 2020. We're looking at a period here of longer than 20 years. The global stock portfolio would have rattled investors with its volatility, but the investor would have needed to be really patient to recognize that the hope is that stocks will beat all other asset classes long term, but to have the patience to wait it out. And sometimes it takes great patience indeed. This is over a 20-year period, And global stocks, in this case, would have underperformed more balanced portfolios. Here's a 25-year period where it's much the same thing. It's a little better now for global stocks, but still the 60-40 allocation beat out the 100% global stock market allocation. Over 30 years plus, yes, the 100% global stock allocation would and should, let's hope, beat out some of the more balanced allocations, but sometimes it can take a really long time to wait for that. Here's a performance chart representing global stock index and the US bond index. You can see in January 2020 how the global stocks dropped. This was based on the coronavirus crisis fears as it related to the stock market. It dropped considerably. We're looking at year to date, May 25th, 2020, a drop of about 13.93% for the global stock market measured in US dollars. And then you can see how the US bond market index actually increased by just over 5% per year. My Canadian bond market index did something really similar. Bonds aren't the thing you purchase to make money. The interest rates tend to be really low, but they don't fall like stocks do when stocks crash. So when stocks crash, bonds don't crash along with them. So most typically, in a year where the market's crashed, stock market crashed, the bond market tends to stay relatively stable. So it may fall, it just may not fall as far. It may even rise, as you can see an example here. But it's the rebalancing that's really important, because rebalancing a portfolio between stocks and bonds allows you to reduce risk. It also allows you to be a little bit greedy when others are fearful and a little bit fearful when others are greedy. So having bonds in the allocation isn't necessarily the long-term detriment that many new investors think it is. Real estate is not like bonds. Some people will say, I've got a couple of rental properties, and so I don't need bonds at all. A real estate or a property that's being rented out is more like a business. It has capital expenditures associated with it. It doesn't always increase in price. In Victoria, British Columbia, my parents bought a home in 1992. It's probably one of the hottest real estate markets in Canada. They found that 10 years later, it wasn't worth any more than it was in 1992. So prices don't just go up when it comes to real estate. They can go flat and they can go down for a while as well. Capital expenditures, you may need a new roof. Your tenant may decide that he or she is going to destroy part of the inside, or they may just leave and you can't find a good tenant for a while. So there's that risk of that income. So that's why it's more like a business than it is like a super stable bond. So it's important not to say, hey, look, I've got real estate, so I don't need a bond allocation to my portfolio. It's not the same thing. Here are factors to consider. Your risk tolerance. Can you tolerate seeing potentially your money not make money for a decade or longer? Patience is essential for all investors. Are you going to get an upcoming defined benefit pension? So are you a school teacher working for a public school system whereby they're going to give you guaranteed monthly payouts upon your retirement? If that's the case, then you may be able to technically go with a lower bond allocation and a higher stock allocation. However, do remember, I mean, of course, the defined benefit pension is somewhat bond-like, but do remember, if that's going to trip you up emotionally, if you go for an 80-20, for example, 80% stocks and 20% bonds, which I would call a fairly assertive or aggressive portfolio, if that ends up not giving you the results that you want, especially through a time period where stocks really go sideways, are you going to capitulate? Are you going to give up on your plan? It's really important that you don't, but if you're the type that would, even if you have an upcoming defined benefit pension, you may want a higher bond allocation. Remember age as well, so young people often have time on their side, so they should be able to afford a higher tolerance for volatility. They could go with a higher component of stocks, but even saying that, there are many young people I know who really don't like to see volatility at all, and so even for them, slightly higher bond allocation could be suitable. Here are some quotes to ignore. You don't want bonds, they pay such paltry interest. Your interest isn't necessarily what the interest rates are now, but you're interested more in what the interest rates will be in the future. If you think you or anyone else can see the future, if you can, stop watching this and go out and save somebody. You don't know what the stock market's going to do going forward. You don't know what the bond market's going to do going forward. All we know is that historically, bonds don't crash like stocks do. So when we rebalance them with a globally diversified portfolio, this helps reduce risk and increase stability, and sometimes, especially during market volatility, even enhance returns. With COVID-19 and government debt, bonds will struggle. Again, you don't know what the future will hold. So we could look at, well, the Japanese market, where you have a government that has massive debts, far higher than the United States. The United States right now, their debt level it's about 119% of GDP, which is pretty high. Japan's is 238% of their GDP. They really started struggling and have struggled, well, for a number of years. But if you look at Japanese government bonds from 1990 until 2020, when hedged to the US dollar, the average return has been about 5.3% per year. So you just don't know how an asset class is going to perform or how bonds will perform based on the debt level of the country. Over 30 plus years, the higher stock allocation should win, but it won't always win. So just recognize that as investors. Over shorter periods of time, it won't always win. So set your tolerance for risk. It's not how the allocation performs, it's how you perform that matters. And they're not the same thing. If you have a super steady hand and you're like a machine, then yeah, it could be how the allocation performs. But as a human being, we are affected by movements, by seeing our monies move up and down. We have to ask ourselves some really tough questions, honest questions. I'm Andrew Hallam, author of Millionaire Teacher and Millionaire Expat. If you like this video, please click like, post a comment below, subscribe to my channel, and I hope to see you in the next section when I talk about Vanguard's target retirement funds for Americans. Thanks very much. Bye-bye.